Today on Retire with Purpose, 5 tax strategies for small business owners, how to use your 401k to buy a lake cottage, and banking like the Rockefellers.
Are you prepared to retire with purpose? To retire knowing your savings is invested to meet unavoidable needs and expenses.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Certified financial planner Casey Weade is president of Howard Bailey, an advisory firm that believes successful retirement begins with a detailed financial plan personalized to help achieve your life's purpose.
Whatever risk you faced, we've got a plan.
The Howard Bailey team is committed to practical financial planning so you can enjoy family and the future without uncertainty or stress. Stay tuned and learn how you too can retire with purpose.
Hello, thanks for joining us. My name is Lee Kelso. I'm here with Casey Weade, certified financial planner, and he is the president of Howard Bailey Financial. Casey wrote an article for Kiplinger's magazine recently about 5 tax strategies for small business owners. And I know this concerns you because not only are you a small business owner, but you also work with a lot of entrepreneurs and small businesses.
I do, and I find that a lot of small business owners and entrepreneurs, we get so wrapped up in just running our business, the day-to-day operations, and making sure that we pay attention to the cost of goods sold, we pay attention to our marketing expenses. A lot of times we're benchmarking all these things and focusing on that bottom line, we kind of forget about one of our largest expenses. And one of your largest expenses as a business owner is taxes. And I myself have implemented a lot of tax advantage strategies over the years, working with CPAs and tax attorneys, that I wanted to share these strategies with other people.
So why is it then that more small business owners aren't taking an active tax strategy approach?
NerdWallet did a survey, and what they found was the #1 concern that taxpayers have is the risk of audit. And so they avoid taking deductions that the IRS has put in place for us because they're concerned that they're going to have a higher risk of audit. And I think, one, we shouldn't be concerned about being audited. And especially if we're taking, say, a home office deduction, that's one of those things where it's often said, well, you're at a higher risk of audit, but there's nothing, no study, there's no reference or anything to substantiate that claim that you're at a higher risk of audit. So if it's part of the law, you should be taking advantage of the law that's actually been put in place. And the likelihood of you being audited in the first place is actually pretty darn low. In 2016, there were only 0.7% of tax returns that were audited, and those taxpayers that have over $200,000 in income, they're the ones that are typically more concerned. They're the target for the IRS, right. And only 1.7% of those individuals were actually audited. I'm not saying that you shouldn't be concerned about being audited. I think you should be, but you shouldn't say, well, if I take this deduction, I'm at a high risk of being audited, I'm not going to do it. You just need to make sure that you're following the letter of the law, you're taking the deductions that are available to you, you have good records, you keep good records, and you're working with a CPA, you're working with a tax attorney that can help you with the audit process if it does occur. Otherwise, you're letting money fall through the cracks.
Yeah, I had no idea the numbers were that low. That's good to hear. So first off, your #1 of the 5 strategies is start saving for retirement.
And this is one that's probably in every article that's ever been written about tax strategies for small business owners. And I kind of hated to put it in there because it is so common sense, but it's something that's so often overlooked. I've got a friend of mine that has owned a business for nearly a decade, and he had never actually started his own retirement plan. Everything was being poured back into the business, and he would take distributions and he would pay for these taxes, and he'd put it in a taxable account, and he was saving that way. And he was missing out on deductions that he could have been taking, and he was missing out on the opportunity to put even more away for retirement by having a retirement plan. And this doesn't have to be expensive. It doesn't have to be complex. Many times you can just do it by yourself. You might be able to do it with a bank. You might be able to do it online with an online bank or brokerage institution, setting up a SEP if you're a sole proprietor, setting up a simple IRA or a 401k for a larger business. And it's never too late either. And I think some people say, well, it's too late now. You know, I'm 50, I'm 55, and I'm going to retire in a few years. But then for those individuals, they can look into things like cash balance pension plans, where they might be able to save $100,000 or more, $150,000 on a tax-deferred basis, and set that aside and get deductions today for funds that they can use in retirement. There's a lot of different options.
This one kind of surprised me, actually, and that is you suggest hiring family members.
Yeah, I mean, think about it. When you run a business, your whole family's involved in the business. Sure. I mean, I haven't met a business owner that says, oh, well, my wife doesn't have any input on the business, or, you know, the kids don't help around in the business. And it doesn't just start with your immediate family, your spouse, your children. I mean, we also have people that I've worked with that are helping out their grandparents, they're helping out their parents. And so they're taking these dollars, they're paying taxes on them at a higher tax rate, then they're paying for expenses of their parents, of their grandparents. My mom's employed in the business. She takes phone calls in the off hours. She helps with organization and things around the office. There's things that she can do that justify pay and at a lower tax rate. The same thing can be said about your children. Your children should be employed in the business. Teach them about money. Teach them about hard work and the value of a dollar. And for your children, they've got expenses. You know, they've probably got preschool expenses. They've got clothing expenses. Why don't they pay for those things? And you might pay them only $5,000, $10,000 a year. Make sure they're legitimate employees. Make sure that they're paid appropriately. And then their standard deduction might cover all of that taxable income they're getting, and it comes to them tax-free, and you pay for their expenses with those things. Again, follow the letter of the law and consult with a CPA or a good tax attorney. And there's a lot of things we can do with corporate structures as well. The other two parts of this article, understanding S corporations, understanding C corporations. With an S corporation, you might be able to avoid 15.3% in self-employment tax by taking part of your income in distributions rather than wages. If you own a C corporation, there's fringe benefits you might be able to get. You might be able to deduct long-term care premiums. We've helped retired business owners who really aren't generating a lot of income set up a C corporation. They're planning on draining it most of the year with fringe benefits, long-term care expenses. They've got these expenses that they can deduct from a C corporation that if they take the income through an S corp, that it wouldn't be as advantageous. And so that there's just so much I think to understand and so much opportunity for business owners. The reality is, when I've worked with families, when I've worked with business owners to do this, once they feel better about their own financial circumstances, they're able to do so much more for their business because they can more confidently make business decisions.
Yeah, if you'd like to see all these 5 tax strategies, you can go to retirewithpurpose.com, look for podcasts there, and you'll see the 5 tax strategies. Lots of details in the online article, and you'll find it at retirewithpurpose.com. So if you'd like to have a coach on your team to help you think through exactly what type of tax strategies might fit for your particular circumstance, be one of the next 10 people to jump on the phone and call the number now and request a complimentary review of just what's going on in your world. Are there tax opportunities you might be able to take advantage of? Social Security strategies, a lifetime income strategy, long-term care. There's so many things to think about with retirement. Are you being guided by someone who knows as much and is as active as Casey and the team at Howard Bailey? Here's a chance for you to find out what you could learn. Call the number on your screen and make that appointment. It's easy to do, and you'll be glad you did. All right, we'll be right back in just a second. We have questions from viewers, so you stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
We begin our viewer questions today with Bruce and Diana from Fort Wayne.
Casey, a question. We've been retired now for a couple years and have been wanting to buy a lake cottage. We wondered if we could take some of the money out of our 401k because we don't need that all right now for retirement, and then later on be able to put that money back in the portfolio.
Well, Bruce, Diana, this is something that I run across with a lot of the families we work with because we live in, the land of the lakes, and there's a lot of great opportunities. If you're going to live in Indiana, you might as well live on a lake, and there's a lot of great lakes to live on. And most of the families we work with, their entire retirement savings is tied up in tax-deferred retirement accounts like 401ks. And if you just take a distribution from that 401k and go buy the property, you're going to owe taxes on that distribution unless you get it back in there within 60 days, which is pretty unlikely you're going to be able to do a 60-day distribution and then get it back in within time and avoid taxes. If you're under the age of 59 and a half, you might have a 10% penalty tax to cover as well. And so one of the things that you might want to think about doing is, if possible, if you can do a rollover and still stay employed, it sounds like you're still employed, you could roll those funds into an IRA, and you can actually own real estate inside of an IRA. And so you don't necessarily have to take the distribution and then hope to get it back in later. You could potentially buy it while it's still staying in that tax-deferred status. There's some rules to understand there, and I would recommend you work with a good CPA, maybe even an attorney, in order to get that done. But that's one of the things that you might want to evaluate as you're going through this process. I would also take into consideration that when you buy a property, I think a lot of individuals forget about all the expenses that come along with a lake property. And are those expenses are you going to be able to cover those other expenses and not put a hindrance on your ability to ultimately retire? So keep all of those things in mind as you're going through this process. I wish you the best of luck as you find yourself a good lake house.
Yeah, it's not just the new roof on the lake house. It's the boat, it's the jet ski, it's all those things that come along with it, right? Yeah, you got to watch out for that. Let's get to Albion and Mike.
My college-age son is looking to be a financial advisor someday. Do you have any advice for him?
Well, Mike, I think it's awesome that you've got a college-age son that's looking to become a financial advisor. The last time I read about college financial advisors under the age of 30, I think there were only 5% of financial advisors that were actually under the age of 30. There's not a lot of young individuals that are getting into this business, and we could really use some great financial advisors to come into the business of financial advice, especially if they have a college education, because many don't. And so it's great that they're doing this, but there are some things to watch out, because the business of financial advice is very difficult. There's been studies that show that there's only a 12% success rate with financial advisors. 12%, that's pretty darn low. That means most financial advisors that get into the business of financial advice, 90% of them aren't going to make it. Even with some of the biggest brokerage firms in the country, their success rate over 5 years is a little over 30%. So even if you're with a really large company and you have a lot of confidence you're going to be able to make it, you're not necessarily going to be able to. And here's the reason why. Because when I first started, I was recruited by one of these large brokerage houses. And one of the things they had me do was put a list together of 100 names, my family and friends and acquaintances, and these were the individuals that I was going to be able to go out and sell to. And this is how they do it. This is how most of these offices work, most of these brokerage firms work. And then once you burn through that list of friends and family, you're out of leads. So he needs to look for a firm that's going to provide him good financial education and a good lead source, and be able to be patient with them so they're not just throwing him to the wolves. I actually have a new advisor that's working with our team that came from a large national brokerage house, and he said he was previously a Marine. He was actually a helicopter mechanic in the Marines, and he said, before he was able to hop on a helicopter and help them with the mechanics, he was supposed to be there in flight. If something went wrong, he could fix it. Before he could even get on that helicopter, he had to know that helicopter inside and out, because he was going to be in charge of all the other lives that were on that helicopter. He said when he first got a job as a financial advisor out of the Marines, he said, whoa, I'm a financial advisor, this is great, but they never actually trained him what he was supposed to do from a financial planning standpoint. He just had education on sales language, he was knocking on doors, and they were telling him, well, this is what you do when you go out and sell, but he felt like he was taking risk with people's lives that he wouldn't do in the Marines. And so he joined our firm because he knew, I'm willing to take a back seat and learn for a while I make sure that I know all the different things I can do for tax planning, income planning, investment planning, all these different aspects of financial planning, so that I'm not putting people's lives at risk. So make sure that he's finding a firm that will provide him that education before they just start getting him out there and selling.
Our next question is from Kathy, and I like this one, from Niles, Michigan. Lots of people may be wondering about this. Casey, do you think a home equity line of credit is better than doing a reverse mortgage?
That's a really good question, Kathy, because a lot of individuals, as they step into retirement, are saying, well, I need an emergency fund. I know that. I'm just going to use this home equity line of credit. I'll set up a HELOC with a bank, and then I'll have the ability to draw off of it if I have an emergency, if I need to put a new roof on the house, if I have a car breakdown, down. If the kids need to borrow some cash, well, I've got this home equity line that I can rely on. But the reality is, if we look at what happened during the financial crisis, a lot of these equity lines were cut altogether. A lot of these equity lines were called. It's not a guaranteed line of credit. You don't know that those funds are actually going to be there. Dr. Weade was one of our recent podcast guests on Retire with Purpose podcast, and he explained how a home equity conversion mortgage, also known as a reverse mortgage, can be a much better tool to use if you're going to go down the road of looking at using your home equity as an emergency fund. You can set up a reverse mortgage without an income stream, and it can be a pool of cash that you can draw off of. And it's a much more secure and stable way to do so, and that pool of cash will actually grow over time. So you always have a growing emergency fund that will be there, and it can't be canceled like a home equity line of credit can. But at the same time, if you have the ability to not take on debt in retirement, then you should do so, and you should plan ahead for that. I hate seeing people take on debt during retirement, and using debt as an emergency fund is really a horrible idea in general. But if you're going to go down that road, make sure you listen to that podcast, listen to Dr. Pfau's research, and really understand all the ins and outs of what you're about to do.
Yeah, and if you'd like some help figuring out exactly what might be a source for your emergency fund, some other financial questions, be one of the next 10 people to make a phone call right now to the number on your screen and request a complimentary meeting with a member of the Howard Bailey team. We'll review lots of factors that apply to your retirement, including not only fees and taxes you might be paying. Is there a source for an emergency fund? What creative financing can you apply there? What about taxes? And is there an opportunity to create a long-term income, one that you can't outlive? All important things to think about, and I'll cover all of that in that complimentary retirement review with a member of the Howard Bailey team. If you're one of the next 10 people to jump on the phone and call the number on your screen right now, hope you will. All right, here's our question of the day, and it has to do with how much wealth will baby boomers transfer to the next generation in the coming decade? The answer when we come back.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
Well, how'd you do with our question of the day? It was, how much wealth will baby boomers transfer to the next generation in the coming decade? These are massive numbers. Casey, which is correct?
Well, the answer, according to Forbes in an article I did in conjunction to the Next Avenue, was the C. It was $30 trillion. $30 trillion over the next 30 to 40 years. The biggest wealth wave in history is set to pass on from the baby boomers to the next generation. But the reality is, and what the article pointed out as part of our weekend reading as well, it showed us that 70% of those intergenerational wealth transfers will fail by the second generation. And it's not necessarily due to taxes, as you might think, because a good chunk of these dollars have never been taxed. So sure, a lot of these dollars will get sucked away in taxes. But I would argue that it's not just taxes. It's much bigger than that. It's this generation's responsibility to communicate what those dollars were really worth, what it took to actually accumulate those dollars, what the value of those dollars were, and what you expect those dollars to accomplish for that generation, what you want to see as your legacy. The greatest generation was also known as a silent generation because they never talked about money. They never communicated these things to the next generation. And I think we're slowly getting away from this. We're seeing more baby boomers communicate these things to their loved ones, to their children, to those that will be inheriting these dollars than ever before. But I still think we need to do a better job at it. If you want them to use it for their college education, then communicate that to them. If you want to use it for charitable purposes, or if you don't want them to spend it, you want them to pass it on to the following generation, then you need to communicate that with them, involve them in the financial planning process. And this is part of the reason that we had Garrett Gunderson join us on the Retire with Purpose podcast, because he has devoted his life to making sure that these intergenerational wealth transfers actually occur occur, and they occur successfully. He wrote a book about the Rockefellers. He said, what would the Rockefellers do? And this was a book that contrasted the difference between what the Vanderbilts did and what the Rockefellers did to make sure that their wealth transferred on for generations. And it had a lot of value, purpose, and vision, and mission was ultimately fulfilled. And he put together a planning process called the Legacy Ring. And this Legacy Ring is made up of 3 primary areas. One of those areas is the family office. So the family office, it really works like this. You have your CFP. It's all about communication. You have your financial planner, and the Biltmores, or I should say the Rockefellers, they had their own team. You may not have your own team that's working with you, but you can still construct your own team with your CFP, with your CPA, with your estate planning attorney, your insurance agent. Get them together once a year and see if there's money that might be falling through the cracks. The second part of this is structuring a family constitution, which he outlines very well in the podcast and in the book. The family constitution is such a neat concept. You know, in the U.S., we have a constitution that's guided our decisions as a country and led us to be one of the most dominant forces in the world, if not the most dominant force in the world for the last 200 years. Why not implement the same thing in your trust language? Instead of just all that legalese that's inside of that trust, why not have something that actually guides the values that you want to pass on to the next generation? And the last part of this was the family retreat. This is something that our family does, not quite as diligently as Garrett does with his own family, but sitting down once a month is what Garrett does with his children, with his spouse. They get together, they talk about their values, they talk about what it takes to make money, what their goals are for the next year, what their goals are for the following month, how their children are going to generate an income. He talks about these things. It's all about communication. And he said at the core of all of this is something called cash flow banking. Let's see what Garrett has to say about that.
And at the center of all that is cash flow banking, which is having the type of insurance policy that lives a day longer than the individual, so it replenishes the trust in case it was lost to business losses and mistakes, economic downturns, so that the money will be there for generations to come.
Well, and this is such an interesting concept, talking about cash flow banking, you know, because it's something that most people don't think of. We think about our 401ks as the best place to save for retirement, and this is one of the things that Garrett has been criticized from in almost every one of his books. He's beat up the 401k, saying that this isn't the best place. This is really not the best place for you to be saving for your, or not just saving for retirement, but to make sure you have the most prosperous life you possibly can, especially if you're a business owner. Let's see what Garrett has to say about 401ks.
The 401k is not supportive of economic independence. It's supportive of retirement. So it's not creating cash flow. It's an accumulation vehicle. And could it be the right thing? For the right person, yes. I have a few concerns about it. So my first concern is limited amounts that you can borrow from it typically. So if the right opportunities come, your money's kind of locked away. The second thing is it's not a tax savings vehicle, it's a tax deferral vehicle. And if you're deferring tax, the questions you have to ask is, number one, will I be in a lower tax bracket in the future? And number two, if I am, is that a good idea?
My biggest takeaway from this was that he said it's not a tax savings vehicle. You know, this is a tax deferral vehicle, but I think most of us think about a 401k as a tax savings vehicle. But really, you're just going to end up paying those taxes down the road, and maybe more taxes than you actually started with on the front end. And so it's really important for us to understand how our 401ks work, how this whole cash flow banking thing works. And this is what the Garrett had to say about how cash flow banking actually functions.
This is a storage tank for your money, and that cash value is available when there's a time of a downturn and opportunities become more rampant. It's a time to store money where things are overinflated, they're overvalued, or you don't feel like allocating money towards anything that has any degree of risk. So it can be a tool to store cash where it's protected from liability and in bankruptcy, purely protected in 43 states, partially protected in 7 other states, protected from tax and giving you a tax advantage because it's FIFO, meaning you can pull your money that you put in out first tax-free, where most of it's taxable first. You can borrow from it to avoid tax. You could pay it back in, and you got the death benefit that can kind of come back in and replenish everything for your family. So, or for the trust in the future.
Well, I love what he had to say about how cash flow banking works, but one of the biggest criticisms of using life insurance or cash flow banking is the subpar returns that you're going to get inside these vehicles. People, and especially brokers, say, well, you're going to make 7 to 10% in the market. Why would you put it in a vehicle where you're going to make 3 to 6% per year instead of 7 to 10% that we could actually make if we invested these dollars in the market? And I think another piece of information that he shared with us is what a lot of investors are feeling today. They feel that a lot of things are overvalued. This isn't the best time to be buying a new piece of real estate or getting invested in the stock market. So where do we store this cash? Well, we're waiting on the next big opportunity. And another really interesting thing about Garrett is that he has no vested interest in selling you a product. He doesn't sell products. He doesn't sell life insurance. He's just sharing with individuals what he's implemented in his own financial life. So why would Garrett accept a subpar return of 3 to 6%? Well, let's see.
So you use the cash when the investments are right, where in most retirement plans, you're just kind of riding it out. So yeah, maybe you get 7% or 9%, depending on what the market actually does net of fees, but you still have to pay tax on the back end, where you're not paying tax on that 4 or 5% that you've earned inside of the plan of insurance, and you're using that cash for other things when opportunities arise, if they arise. If they don't, I'm actually totally cool with 4 or 5% because I'm earning more than I'm paying in any interest if I choose to borrow. And I can always take distributions or dividends off the money that I've gathered there. And I'm really building, for me, most of my wealth inside of my business. So even if you have a 401k, one of the best allies or friends for that 401k is a life insurance death benefit, because it's going to be a strategy of how you might be able to get more of that money out of there and spend more of it in the future.
Well, I love what he says here about wealth not being created in the market. It's not created in cash flow banking. It's created in your business. It's created in real estate. It's created in these outside opportunities, and we have to have the cash available when these opportunities arise. You might make 20 or 30% per year on every dollar that you invest back in your business. Well, that's a heck of a lot more than the 6 to 10% that we might make if we just invest those dollars in the stock market. And many times we just miss this when it comes to our planning.
So I got a couple questions. What size should my portfolio be before I start looking at this cash flow banking thing?
Well, it's a great question because I actually think it's a great question because it's slightly wrong in the fact, but that's where most people go. How much do I have to have? But really where this concept comes into play for the most part is for individuals that have higher incomes. They've already maxed out their 401k, they've contributed to their HSA, their Roth IRA, their 529s, and now they're looking for other tax advantaged ways to save more cash, to have flexibility and tax-free income down the road and leave a legacy for the next generation.
We have to leave it there, but I'm sure we'll pick up on this topic another time. Before we go, I want you to be one of the next 10 people to pick up the phone and request a complimentary review of your retirement plan with a member of the Howard Bailey team, a chance to sit down and review opportunities for cash flow banking, for covering long-term care, a lifetime of income, all those things that are so important when it comes to your retirement plan that you may not necessarily be focusing on as well as you could today. Pick up the phone and call the number on your screen and set that appointment. It is time well spent. We thank you for joining us today, spending your time with us, and we'll see you next week.